Hello and welcome to the Look Ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. We'll be looking ahead to the week beginning the 29th of September. So just before we start, as always, I'm just going to ask you to have a quick read through the risk warning, and I'll just put myself on mute whilst you do that. Okay, so let's have a look at what we'll be watching. I suppose, as always, before we start looking at what we'll be watching, have a quick recap of what's happened this week. We've seen US stocks are pretty much unchanged across the week. Just have seen them ease away from that record high that was reached earlier in the week. Yeah, as I said, broadly unchanged. This is the S&P 500 that we're looking at here. US dollar remained relatively strong, just pushing up a bit higher. And this is as investors digested a less dovish than expected speech from Federal Reserve Chair Jerome Powell. In addition to stronger than expected data, GDP data was upwardly revised, and durable goods orders beat expectations, and jobless claims were significantly lower than expected. Core PCE, the Fed's preferred gauge for inflation, was also in line with expectations. So, you know, add all this together, and it just does raise some questions over the outlook for the Federal Reserve's rate cuts. Let's not forget that the previous week we saw the Federal Reserve cut interest rates by 25 basis points, and also the dot plot point to two more rate cuts this year, 25 basis points in October and again in December. So, you know, the market was looking for further evidence really to support those expectations of rate cuts, but didn't really get it from Powell, who instead actually warned over relatively high valuations, which has hit US indices a little bit, but also very much played out the idea that there are risks to inflation as well as the jobs market. So the uptrend, I mean, looking at the S&P 500 here, is still very much intact, even though we did see a slight pullback from those all-time highs. We have seen the market continue to really just crawl northwards as investors look to invest in something. And as I said, the US dollar has staged a little bit of a recovery again this week. See, we're just rising above this trend line dating back to March, just testing it really, and also testing the 100 SMA there around that 98.36 level. So if we're seeing a Federal Reserve that's potentially not going to be cutting interest rates as aggressively, that may mean that there could potentially be a little bit of upside for the US dollar. Now, let's crack on with what we've got to be watching this week. Quite a lot going on. We've got Chinese data, we've got RBA, we've got UK GDP, German retail sales, Eurozone inflation, and the big ending will be for US ADP, ISM manufacturing, and the non-farm payrolls on Friday. So in addition to that as well, we've also got these concerns over the US government shutdown. So this is on Tuesday. Let's just take a look at what this might mean. On Tuesday, basically, the government will know whether the US government will, sorry, the market will know whether the US government will be shutting down. And this will happen if Congress fails to approve funding legislation required to finance the federal government. So what makes it interesting this time is that the White House has told agencies to prepare for government firings rather than the usual furlough approach, which would then see those employees return to their jobs once Congress approves a new financial plan. But if you do see mass firing, that could eliminate the employees, and it could have a heavy impact on jobs data, as well as an impact on the broader economy. So that also would have policy implications, which is why something like that could actually have quite an impact on the market. So we're watching that potentially more closely than we have government shutdowns in previous occasions. Now, there is this sort of uncertainty surrounding the US government shutdown, which is helping to support gold. Gold is trading close to its record highs. Today it reached a level of 33,783, so just off that 3,791 record high. Still, RSI is still very much overbought, so I mean there is a lot of potential here to see some consolidation or even a move lower. As far as what to be watching out for, if we do see the shutdown and go ahead and those workers fired, then that could actually push gold significantly higher, breaking above that 3,800 level. On the downside, levels we're watching 3,700 just as an immediate support. That was last week's high, and then below that we've got this level here, which is the 3,620. That was sort of the low that we saw in early September. But I mean, this is a big move up. It doesn't really, we'd need to get behind below 3,500 to really negate that move, or even as low as 3,425. So gold is going to be very much in focus. Gold's also going to be in focus because of the non-farm payroll report as well. But let's just have a look at a different area. Let's have a look at what non-farm payroll report jobs manufacturing data may mean for the US equities. So just as far as the non-farm payroll is concerned, expectations are for, I think that's around 39,000 jobs to be added to the economy in September. Now, the last couple of months have seen non-farm payrolls come in well below expectations, and there have also been strong downward revisions to previous months. So it's fair to say that the overall trend in employment points to a significant slowdown, and that's a message, which really helped the Fed drive for that rate cut this month as well. And given the importance that the Federal Reserve have been given the health of the labour market, that does mean that I think this will be very much in focus. Now, this report is on Friday, so it does mean that there may be a little bit of wait and see mode, but not necessarily, because we've also got that shutdown on deadline on Tuesday, and there'll be other data points as well, which we'll come to, but I'm just going to potentially most important first. And so I mean, we've talked about why this is important. Now, the thing to be watching is if the jobs data does actually come in stronger than expected, then I think that's going to help calm, concerns over the US labour market, which, combined with inflation at 3%, could actually see the market rapidly reassess the likelihood of 2 more rate cuts this year. I think the more complicated outcome would be if there was a weaker than expected non-farm payroll report, which could really highlight the deterioration of the labour market at a time when inflation remains high. And this picture would be much more complicated because the Federal Reserve would need to be tackling sticky inflation and a weak jobs market, 2 factors which require conflicting monetary policy measures. So this is the NASDAQ that we're watching. It did hit a record high there of 24,780 earlier this week. Has just come away slightly, but we're still seeing it. It's still in that rising channel, just testing that midpoint of the rising channel around the 24,400 level. I mean, this is still very much an uptrend. We've seen the RSI come out of overbought territory. It's fading bullish momentum, but still very much in that rising channel. Just levels to watch on the downside, 24,000, and then below there we've got 23,400. It would take a move below this one here, which is the 23,000 level, to create a lower low and potentially see a deeper sell-off towards the 200 SMA. On the upside, buyers are obviously going to be looking on the upside if we get some data, what we call Goldilocks data, which is just, you know, showing weakness in the jobs market without it being too terrible, supporting another rate cut. That could help stocks push higher and towards fresh all-time highs towards that 25,000 level. Other thing to talk about, we've also got the US ISM manufacturing, which is expected to improve slightly to 49.2, up from 48.7, although this remains importantly below the 50 level, which separates expansion from contraction. So if we're going to use the S&P manufacturing PMI as a point of comparison, we actually saw that fell to a 2-month low in September of 52, down from 53 in August. And we also saw that manufacturing output rose, but that was for a 4th straight month of rising output. The pace of expansion slowed sharply. New orders, particularly, have weakened owing to losses from tariffs. Tariffs continue to drive prices higher, with manufacturing input inflation around the highest level since the pandemic. So, you know, it's going to be worth watching these subcomponents of the report. Now, this is the Dow Jones that we're looking at here, just testing this rising trend line, dating back to the April lows, just trying to break through there. The price did find some support here on this level here, which was the high that we saw back in late August, and it sort of seems to be holding that line so far. If we get upbeat data, then we could be looking for a move towards the 46,000. This is the record high that we saw earlier this week, 46,700. And on the downside, 45,750. That was that high that we saw there in August, and which found support here this week as well. Break below there, you'll be looking at 45,000 as the next level to watch. So other things to be watching out for. Just going to talk a little bit about oil. We've obviously got China data, the manufacturing PMIs and services PMIs. Manufacturing is expected to hold steady, just above expansion, manufacturing is expected to just improve slightly, but just below expansion at 49.6. Meanwhile, we're expecting the rating dog manufacturing PMI to come in at 50.3, down slightly from 50.5. So, you know, this is suggesting that manufacturing is just hovering around that expansionary territory, just not really blowing away by any shot of the imagination. In fact, it seems a little bit subdued at those levels. So what this means for oil prices could be quite interesting. Now, oil prices have broken out of this falling triangle pattern, breaking above 65, rising towards that 200 SMA. We're trading at the highest level since early August. This is basically on those geopolitical concerns, particularly surrounding Russia and Ukraine. We've also saw this week that the inventory data showed a larger draw than expected. So these are sort of helping to push oil prices higher. If we see stronger than expected Chinese data, China being the largest oil importer in the world, then we could see that actually pushes oil prices higher towards that 70 level. As far as support is concerned, 65 is the level to be watching. Then we've got this falling trend line around the 63.60 level, and sellers would need a break below the 61.55 in order to create a lower low. I'm going to touch with the euro US dollar as we look towards Eurozone inflation data. Eurozone inflation is expected, it will be released on Wednesday, is expected to rise to 2.3% year on year in August, up from 2%. Sorry, in September, up from 2% in August. However, inflation is still relatively close to the ECB's target level here, with questions really over whether the central bank will be cutting rates again this cycle. So as a result, you know, the data may not really provoke much of a reaction in the market, but it could offer some support to the pair. It's worth noting that ECB President Christine Lagarde said that the central bank was in a good place with inflation being where they wanted it to be, and the market only sees a 35% probability of another 25 basis point rate reduction by June next year. So in other words, yeah, the ECB is pretty much considered to be done with the rate cutting cycle. So this is the euro US dollar pair that we're looking at here. Now we can see that the pair rose to that, broke out of this falling trend line here, rose up to 2025 high of 119.18, has then moved lower. So we've broken below this rising trend line support here. We're testing the falling trend line support here, and also the 50 SMA just around the 116.70 level, which is also this horizontal support. So we're at a pretty key support level. So sellers are going to be seeing if they can break below that level. If we get weaker than expected inflation, then we might find that that level gets taken out, especially because there are also ECB members that are closely monitoring the value of the euro against the US dollar. So any sense that the euro is weakening will help ease some of those concerns of a strongly valued euro, which can cause disinflation in itself. So as far as if we get stronger than expected inflation, then look for a rise above the 118.50 level, 118.30 level. That was the high that we saw back in July, in order to bring the 2025 high back into focus again. So what else are we going to look at? We're looking at the Aussie US dollar because we also have the RBA rate decision. So basically the RBA is not expected to cut interest rates. They're expected to leave them unchanged after cutting rates by 25 basis points in August, when inflation was seen to be cooling. Now, interestingly, they also updated the economic projections, suggesting that underlying inflation was set to continue to ease and interest rates could remain on a gradual path to easing. Since the meeting, however, we have had unemployment, which remains at around 4.2%. But we've also seen that monthly inflation has jumped to 2.8% in July. That's up from 1.9% in June, and it rose even further to 3% in August. So as a result, the market's really pushed back on RBA rate cut expectations, not now fully priced in until February next year. For this meeting, there's just a 7% probability of a 25 basis point rate cut. This is Aussie dollar, US dollar that we're watching. Again, we saw that rise towards that 2025 high of 66.75. Since then, we've seen this pair has been falling lower, drop below this sort of level here, which has been important, around the 60, just below the 66, so around the 65.90 level. Coming down here and just testing on the 50 SMA, which is at 65.50. That seems to be just limiting the downside for the time being, but we've got momentum is also pointing lower. So, you know, if we have a slightly dovish sounding meeting, then we could see the sellers look to take out these supports there at 65.50 and at the 50th May at the 100 at 65.15. Below there, this is the level here, 64.25, the lows that we saw back in August that come into focus. And if we have a more hawkish sounding RBA, then we could see that buyers look to recover above the 65.90, 66 level to bring the 2025 high back into focus. So I think that's pretty much everything. We've been through our GDP. Let's have a look at what's going on in the UK, because I think the UK has been struggling. So we've got GDP is expected to just confirm the 0.3% growth for the second quarter. Interestingly, the month-on-month GDP, I think it was for July, came in at 0%, so it's stalling. We've also seen some volatility or unrest in the UK gilt market, and this is basically as we look ahead towards the budget. The budget from the Chancellor in November, late November, but actually what we've seen this week is there has been a sense that global investors have been shunning UK gilts because of concerns over the Rachel Reeves' ability to get sort of her fiscal position in order at the ahead of the budget next week. But we've also got the, not next week, in November, but we've also got the conference, the Labour Party conference next week. So the market's going to be looking really for any sense of that Rachel Reeves may have this situation a bit under control, because given the amount that's been spent, given the amount of borrowing going on, we've seen borrowing costs jump up. Growth is looking anemic at best, the outlook. It does mean that Rachel Reeves could struggle at the budget to balance the books, looking that there is a pretty large black hole that needs to be filled. And the market is going to want a sense that she has this under control, which is not necessarily being portrayed at the moment, which is why we've seen these bond markets behave in the way that they have. Right, so just as far as technicals are concerned, look, we're testing this level here, really important. 133.60 been tested. This is the fourth time it's been tested now. Well, we've got this breakthrough here, but if we do get a breakthrough 133.60, watch out for 131.60 on the downside. On the upside, you're looking for a rise above this sort of 134.50 level, which is key. It's got the trend lines, it's got the horizontal resistance as well, and so above there, then we'll be looking to move towards 136. So I hope that you've liked everything that you've seen today, and we look forward to seeing you again next week.